Hello and welcome to this special program. We are calling this the Global Reset under Trump 2.0. I'm Prashant Nair. The new U.S. administration under President Trump seems determined to upend the world order as we know it. From tariffs to security alliances, everything seems to be up for negotiation. How does one navigate this changing environment? That's the big question. I have with me someone who tracks all this very, very closely. Louis-Vincent Gave is the founding partner and chief executive officer at Gavekel Research. Gavekel is a financial services company. They do research in global markets, global economics, based out of Hong Kong. Gavekel is widely followed for their institutional research, commentary on daily global macro events, and of course some of the bigger trends as well. I also have with me Manish Bhandari, who's director at Vallum Capital, a fund management business based right here in Mumbai. Gentlemen, great to have both of you here. Thank you very much, Louis and Manish.
Thank you. Thank you for hosting us.
Thank you so much for having me. Us.
This is an extremely interesting time. A lot of things, everything seems to be changing.
It sure is. Definitely keeping busy. Lots to think of, lots to write about, lots to stay in business for.
So let's start with what is most current, most recent, right? Tariffs, Louis. How real are these tariffs in terms of their durability?
Yep.
Because the Canada-Mexico tariffs and, of course, the 10% extra tariffs on China, they seem to be motivated by sort of essentially stopping the flow of illegal drugs into the US, right? It's not to raise revenues, at least that's not the stated objective. So is this going to off-ramp at some point, or you think this is here to stay? These tariffs particularly.
I think you put your finger on it. The big question is, are the tariffs a tool towards achieving something, or are they the end goal? I think so far, there's still a lot of signs that Trump is looking at tariffs like a tool to achieve something else. Now, fundamentally, what does Trump really want to achieve? I think the first goal right now, what seems pretty obvious, at least to me, is that contrary to Trump 1.0, who kept tweeting about the stock market making new highs, and what they're really worried most about is three things. They want to get the bond yield down, they want to get the US dollar down, and they want to get the oil price down. And pretty much every one of these policies that they've implemented, now there's other things, yes, they want to stop the drug flow, et cetera, but everything they're implementing is really driven by these three goals, and including the tariffs. For me, and I could be wrong on this because it's very hard to predict what Trump is going to do next, but for me, the tariffs remain a tool. And it's a tool that you're going to use to beat up America's trade partners, whether Japan, whether Korea, whether China, and to say, look, guys, I'm going to tariff you unless you go out and you buy US treasuries and unless you raise the value of your currency. I think the next few months, we get a lot of this until basically Xi Jinping and Trump meet in May. And then we'll have a better outlook on whether tariffs are here to stay or whether some kind of Mar-a-Lago Accord, to use Scott Bessent's term, whether some kind of Mar-a-Lago Accord gets achieved.
Are the three things you mentioned consistent with a higher stock market?
I don't think it's as much of a priority, to be honest.
That's an interesting, important point, because, I mean, the general assumption is that he's very focused on the Dow being at a new high. It's like a point of pride. But you're saying actually the target this time is not higher stock markets, it's lower cost of borrowing.
I think so. You'll notice this time he hasn't tweeted once on the level of the stock market.
Okay.
You've had tweets from Elon Musk, you've had talks from J.D. Vance, from Scott Bessent, from Trump himself on the 10-year yield. And I think the reason for that is actually the setup today in the US is completely different.
Yeah.
The big problem is in the second half of this year, you have a massive amount of debt to roll over. Because remember, in the second half of 2020, interest rates were at record lows. Every single US corporate went out and issued debt. You know, when interest rates were below 2%, you're a CFO of a company, it'd be criminal not to issue debt. They all did it, and most of corporate debt in the US is 5 years. So now, these guys all have to roll over the debt in the second half of 2025. If they roll over at much higher rates, that means that CapEx is going to get cut. That means that employment is going to get cut to pay for the debt. They have to get the cost of debt down. Without that, you're facing a really bad 26. And guess what happens in 26? Midterm elections. So take the pain up front, get the lower interest rates, so that the economy can be rebounding by 26 on the back of lower energy and lower interest rate costs.
Okay, let's just complete the tariff point.
Sure.
So I think average tariffs into the US are 2.5%, 3%, somewhere there.
Yep.
By the end of the year, where do you see those?
That's a really tough question because I think a lot is going to depend on those negotiations with China.
Okay.
And here,
But they're going to be higher. We don't know.
I think
if
they're going to be higher because part of, I think, Trump's view of the world is foreigners should pay more. Now, I'm not quite sure how he came to that conclusion, but essentially, one of his hardcore beliefs is foreigners have been taking advantage of the United States and they need to pay more. And a lot of these policies, like the golden visa thing, where foreigners are going to pay $5 million to move here, even though you already have an EB-5 visa that costs $800,000 and only 2,000 people take a year. Somehow millions are going to take the $5 million option. There is this perception of foreigners have to pay. So yes, there will be higher tariffs. The big question is, will it be marginally higher? So you say 2.5%. Will it be 10? Will it be 12? If that's the case, that can sort of come out in the wash. Like if you got a 10% across the board, that's not going to throw the global or the US economy off the rails. If you move to 25, 30, then all of a sudden, that's much more problematic for global growth.
Okay, let's talk about what is important for emerging markets as well, which is the US dollar. You're saying he wants the dollar lower, and so far it seems to be working.
Yes.
Right? Yields are down, I think, about 50, 60 basis points in the 10-year over the last 1.5 months. Dollar is lower as well, the broader dollar. What's your sense, Louis, here?
Well, look, I think when you look at Treasury Scott Bessent, Treasury Secretary Bessent, his very first thing when he got into his new office was first thing he did was to pick up the phone to call his Japanese counterpart and to essentially tell him, look, the yen is too low, which it is. The yen is ridiculously low. If you spend any time in Japan, it used to be that if you went out for dinner in Japan, you'd have to check your bank balance to make sure you could afford dinner. And now, you go there and, things are really, really cheap. So bottom line is, the U.S. does want a revaluation of Japan, does want a revaluation of the won, the Korean won, does want a revaluation of the renminbi. That's going to be, obviously on the table with the discussion with Xi Jinping in May. I think there's a good chance that gets achieved because all these currencies are today massively, massively undervalued. The U.S. dollar is very expensive. You go travel in the U.S. today. For most of my life, traveling to the U.S. Was a decent value experience. Today, it's completely out of whack relative to everywhere else in the world. Yes, the U.S. dollar has to come down. It's too high.
But Louis, isn't it quite conflicting that you are you're doing the fiscal consolidation, and there is a possibility of a dollar going down? You're just talking your way through, or you really want to implement? You can really push this through?
Yeah, that's a great point. You're absolutely right to highlight that usually fiscal consolidation, you tend to have a bit of a stronger currency. Now, having said that, in the past 2 years, you had massively pro-cyclical fiscal policy in the United States, and the dollar still went up because, at any one time, I think you have many factors can impact a currency. Yeah. And in recent years, the biggest factor impacting currency has been interest rate differentials because the U.S. yields were going up, U.S. dollar was going up. If they're going to be successful in bringing yields down, then partly through DOGE, partly through cuts in government spending, maybe a little less issuance of treasuries than the market had expected, maybe arm twisting China, Japan to buy more bonds, a little bit of this, a little bit of that, get yields a bit lower. I think the U.S. dollar does roll over from the current level of overvaluation. I think it's happening, actually. It's already starting.
And I think it'll be good news for capital flows into emerging markets if that were to happen as well. Of course, the other stuff will play out as well. The other thing is the market here in India has been weak. I think the market here in India and the US have been very, very tightly correlated. Two best performing large markets in the world last few years. But here we've started to pull back. US, the S&P is just under 5% away from its all-time highs. Do you think we're starting a correction in the US as well, especially large cap tech, which actually is the only space which has mattered, which has driven the US outperformance, is a top in there? Your thoughts?
Yes. No, I think we've just had a massively important event with DeepSeek. DeepSeek changes the world we live in. It changes it on many different fronts. First, until DeepSeek came around, the perception was that the US could contain China technologically. The fact that China all of a sudden shows that it's at the same level on artificial intelligence as the US shattered this illusion. The second reason it mattered is that up until 10 minutes ago, the widespread belief was that all these huge Mag 7, these big cap tech stocks, could in essence build monopolies for themselves through unprecedented capital spending. That if you wanted to play at the AI table, you needed to put 50 billion a quarter on the table as your ante. DeepSeek has also shattered this belief. And so all of a sudden, the idea that you can spend your way into building a monopoly for yourself, into building ever bigger moats, has been completely undermined. And I think with that, you have started to see a rotation in the market where indeed investors start to say, well, hold on, if Microsoft, Google, Amazon, if they're not going to be the massive monopolies I thought they were, do I still want to pay 35 times earnings, 40 times earnings? Especially if at the same time, you're starting to get other stories around the world. Now, you pointed out in recent years, there's been only a handful of stories. There were really three. It was gold, US tech, Indian equities. That was it. Like anything else you did was kind of lame. But now what you've seen is while the US starts to fiscally tighten with Doge, China is fiscally easing and starting to do a lot of pro-consumption measures. Europe is fiscally easing. And so as the fiscal easing shifts from the US to China and Europe, lo and behold, China and Europe start to outperform. All of a sudden, there's other things to do in the market. Maybe I don't need to just own Microsoft at 35 times earnings. There's other exciting things to do.
There's some very interesting graphics, as you were talking as well, from your research, which we're putting out for our viewers. We will continue this conversation, Louis, and want to sort of connect that with flows as well, right? I mean, there's always this debate whether when money goes into China, we get our money through EM funds.
Yes.
So if China gets money, we get money, or is it, I mean, one at the expense of the other? We'll sort of ask you that. Let's just take a quick commercial break here. We're going to come back, continue this very interesting chat with Louis. Welcome back to the special program. We're calling it the Big Global Reset under Trump 2.0. Louis Gave of Gavekel Research is with us. Manish Bhandari is with us as well of Vallum Capital. And we are continuing our global conversations. Louis, China, let's just finish that point when we took that break, right? You think the Chinese rally, and we've had many false starts over the last couple of years. DeepSeek changed the game in that sense. It also sort of shined the spotlight on how innovative China is at a lower cost level. And it's not just the factory of the world, it's not the cheapest producer, but technologically they seem to be right up there. Do you think the rally is durable in China?
I do, because to your point, I think first there's a change of perspective where all of a sudden you do realize in industry after industry, China is now a world leader. And it's not just on cost, it's also on quality, to the point you just made. But that's not it. That's part of it. That's not just it. I think what we also have to acknowledge when we look at China is that bond yields in China are basically the lowest bond yields in the world. And this is an economy where the pool of domestic savings is just gargantuan. It's enormous and keeps growing. China's running 1.1 trillion annual trade surplus. Now, in recent years, a lot of this money that kept coming into China through the trade surplus, guys would earn it and they would put it in bonds earning 3-4%, or they would put it in real estate, or they would buy gold. Fast forward to today, bonds yield nothing. You get nothing from the banks. Real estate has had the troubles that we know. And then finally, gold is starting to get a little bit expensive. So the default mode is shifting from I buy gold and I buy bonds to I buy equities. And so when you look at today's bull market in Chinese equities, it's not driven by foreign investors, which is the false starts that you alluded to in the past. It was like, maybe Chinese equities are going to be good. Foreigners come in. Yep. After 6 months, they get disappointed. They walk out. This is driven by domestic investors, which in a sense is reminiscent of the bull market you've had here in India over the past decade, which, yes, was driven some by foreign flows, for sure, but was really initially started by domestic investors. Yep. And domestic investors that have, kept going and kept going and kept going, we're just at the beginning of such a trend in China.
They're still going.
They're still going, absolutely.
I have one observation here. There are 273 times in the last 2.5 decades where Chinese markets have gone up by 10% and then again fizzled out.
Yep.
There have been close to 43 instances they went up to 50% and then again fizzled out.
Yep.
So in most of these cases, you said that a domestic investor was never a buyer.
No, that's a fair point.
Yeah.
Of course, you've always had buyers. What's always crushed Chinese, the big market, the big rallies, the 50%, because now we're, if you look from the bottom, we're up like 70% from the bottom. So we're now at a big rally. What's always crushed the big rallies is one of two things in China. The first thing is either massive issuance from companies. Companies say, oh, you guys like this paper? Here's a bunch more. So you get to see IPOs, et cetera. Now you could say, well, BYD just came out today doing a $5 billion issue, but at the margin, it's still very no IPOs, not much in the way of IPOs yet. The second thing that crushes it is the government gets worried about too much speculation and comes in and puts in controls on margin requirements and basically signals parties over, everybody back in the classroom. So far in China, we have neither. We have a government that is still pushing the market higher, and we really haven't had a big proper IPO cycle.
Okay.
The sign of the top in China, for me, will be probably 6 to 12 months after you get the Alipay, the ByteDance IPOs, like all the big names, and all these guys come in. That's when you want to start thinking, maybe I get my hat and I go home.
What is the Chinese, so you're saying it's a proper bull market in China?
I think it is.
It's the beginning of one, essentially, right? So it's not just going to be tech, it's going to be everything. Slowly it'll broaden out.
Well, actually, this is interesting. Most people have missed this Chinese bull market because up until this DeepSeek thing, tech was not participating, right? Like Baba had gone nowhere, and JD had gone nowhere, and Tencent, et cetera. But if you look at the past year, last year, few people realized that FXI, the biggest China ETF in the US, FXI actually outperformed the S&P 500. While tech was flat for the year, it was the banks and it was all the big SOEs, because what you saw in China was as bank deposits started to yield zero, people started to say, zero at the bank, I can buy PetroChina yielding me 6.5%. I'm going to start doing that because PetroChina isn't going to go bust. Bank of China isn't going to go bust. ICBC isn't going to go bust. And so you start to see some of the flows that way. Now what you're seeing is tech is actually catching up. And now the next step is the government keeps saying we're going to do big consumer subsidies in the coming 6 months. Everybody's waiting for what those are going to be. But consumer stocks are now starting to go as well. So now you've got the high yielders, i.e. the banks and the SOEs. You have the tech and the consumer stocks. So yeah, it is broadening out.
Will it come at the expense of India? Flows?
Well, I think that's already somewhat happened, to be honest. Like, when you look at the past 6 months, obviously the Indian stock market has struggled.
Right.
And it's struggled not because domestic investors have sold, but because foreign investors have sold. You've had, I think record outflows actually for India. Now, I think, Manish, you made the point earlier that an environment of, falling yields in the US, stable oil, falling US dollar, if you're the RBI, it's happy days, right? It's like you couldn't ask for more. This is perfect. It also means an environment where if at the same time, the bull market on Max 7 is over, you start to see allocators start to allocate to emerging markets. Now, I think the big story on emerging markets in the past decade was that India was the only good story. Like Russia was obviously you could invest. China was said to be uninvestable as well. Brazil had political problems. So India was the only place. So India got a very big piece of the shrinking emerging market pie. The next 5 years, you're going to see a rapidly growing emerging market pie. But the India piece might shrink, but the piece of the pie will still be bigger than what it is today, if that makes sense. You're going to get a smaller piece of a much bigger pie.
Which is still more.
Which is still more, which is still a bull market.
Unintended consequences of Trump's policy. Yeah, that's right.
Absolutely. Let's talk about commodities, which is the other leg, right? Do you think they're starting something here?
Look,
commodity prices?
Yes. Look, I spent a lot, as you were based in Hong Kong, and I spent a lot of time looking at China. We have an office in Beijing. I spent time there. In my career, each time the Chinese economy started to reaccelerate, because it is such a big economy, it had a positive impact on commodity prices. And all the more so in recent years, because when China does better, you see immediately the impact all across Southeast Asia, all across Latin America. So when I look at the coming year, I think, okay, China's doing better. Southeast Asia is going to do better. Latin America is also starting to do better. India's humming along. Like, I know the stock market hasn't been great, but the economy's humming along.
Yeah.
You know, you put all this together, and it doesn't tell you that, you know, oil's going to $150, but it tells you that the pressure is to the upside, not to the downside.
But not gold so much, right?
So
We talk
gold,
about industrial commodities,
Yes.
the upside, but gold, which has already had a fantastic bull market, you think we're in the last stages?
like I've been a raging bull on gold, and so it's always hard to change your stripes. My concern on gold is pretty simple. I think if you look at the past 3-4 years, you've had two new marginal buyers. The first new marginal buyer were the central banks. When the Western world confiscated Russia's reserves, everybody said, okay, I'm not going to buy treasuries anymore, I'm going to buy gold. And you saw Saudi Arabia, Thailand, Indonesia, China, all the central banks bought gold. I think that's still there, and I think that stays. The other massive buyer of gold were the Chinese retail investors, who had no confidence in their stock market, no confidence in their real estate market. And gold was by default, and especially in the past year, because yields moved to zero in China. So it's like, okay, what do I do with this cash? Boom, I buy gold. If now they start to say, okay, actually, forget gold, I'm going to buy equities, because equities, the momentum is there, they're cheap, they're paying high dividends, I'm just going to do that, then you lose one of your two marginal buyers. And you do this at a time when, frankly, gold is now pretty expensive relative to oil, relative to silver, relative to copper. So I think within the commodity space in the coming year, there's going to be more exciting stories than gold.
Is the silver new gold?
So, look, I'm more bullish silver than gold. I'm more bullish silver than gold because I think there's a number of factors that are going to drive silver higher. One of them, of course, is the world I'm describing where Asia starts to do better.
Yes.
You know, it's silver more cyclical. I think what everybody underestimates is Europe is now moving from 12 years of fiscal consolidation to now big fiscal expansion. That's the big result of the German election.
Yep.
And where they're going to be spending money, everybody thinks it's going to be on defense. I think it's going to be on energy transition. Because when you lose the US protection, yes, you lose military protection, but you also lose the guarantee that the US will always deliver oil for you if you need it. And so I think Europe is going to double down on energy spending, and you can't do energy transition without silver, you can't do energy transition without copper. I'm much more optimistic on those two, constructive than on gold.
Manish, the world that Louis is describing is, I mean, we can live with that, right? Lower dollar, lower yield, lower US yields, lower cost of borrowing. You would agree with that?
Yeah, no, absolutely. So as I said, it's unintended consequences of what Trump is trying to do, and this creates another bull market in the emerging markets if Louis' prophecies are going to come true.
You think we'll get a proper bull market?
I think so. I think it's already started.
Yeah.
To your point, emerging markets have been, laggard and a dollared because you had problems in a number of the big emerging markets. And again, I know India was doing great, but you looked everywhere else. China was terrible. Brazil was terrible. Lots of issues everywhere. And, you look at country by country, and the outlook is just better. And yes, to your point, Manish, like if really the Trump government comes through with its policies of weaker dollar, weaker bond yields in the US, fiscal consolidation in the US while everybody else is doing fiscal expansion, I think the outlook for emerging markets, we're starting a new bull market. This is where the new bull market is going to be.
Well, I think on that very optimistic note, Louis, we want to wrap up this conversation. Thank you very much for dropping by to our studios. Manish, thank you very much for arranging this and being here.
That's my pleasure.
With us at CNBC-TV18 as well. Thank you, gentlemen.
Thank you very much.
Well, I think that gets us to an end in this conversation, but I think we'll have to have many more of these chats over the next 4 years as we continue to deal with announcements, pronouncements, changes, and whatnot. So keep it with us here at CNBC-TV18. It's a wrap for now. Thanks very much for watching.